Is this much worse than you thought?
Yeah, absolutely. The markets move faster, and the fundamental tightness is deeper than what we would have thought 3 or 6 months ago. And I want to emphasize to everyone that this is not entirely a function of the war. These trends were put in place going back a decade ago. The term we used is the revenge of the old economy. And it's not just in oil and gas, it's metals and mining, it's agriculture, it's the entire old economy space. In fact, I would argue it's anything capital heavy. We've ignored capital heavy in favor of capital light for the last decade. And this is what we're ultimately with severe shortages, across some of these really key markets that then were exacerbated by the Russian invasion of Ukraine. So, this is where we should be, but it's a lot deeper than what we would have initially thought.
So Jeff, is it going to get actually a lot worse? What kind of prices can we see?
I think, the upside, particularly in energy and food right now, as we go into the summer months, is severely skewed to the upside. Why am I going to argue that? One, particularly in the context of China, everybody's waiting for the recession. From a commodity perspective, we were in a recession in April and May. Metals demand contracted by 10%, oil demand contracted by 2.5% globally. Those are recession-like numbers. Well, it looks like we're on the backside of China as they come out of lockdowns. And I'm not going to say there's a green light, but the acceleration facing demand out of China between now and the summer months, particularly given the fact that the stimulus that they're putting in the system is the third largest since the financial crisis. So one, China. Two, Russia, the sanctions are likely to start to bite more deeply as we go into year end. We'll see if they actually implement them, but it's going to tighten it from the supply side. Then let's not forget, people haven't been on holiday for 2.5, 3 years, that the travel season this summer is likely to be, it already is, a record level in terms of just looking at airline tickets.
Jeff, but when you look also at oil, I mean, refining is without a doubt one of the biggest, if not the biggest problem in the oil markets right now. So how will that pan out? Is there any side to the capacity crunch?
Well, when we think about where the shortage is coming out of Russia, it's in the refined product side, more so than it is in the crude side, because they essentially have taken those refineries off the global market. Now, when we think about the ability to bring on refining capacity, that takes decades, and there's nobody who's actually built a new refinery in the West since 1977, which is an indication growing the supply here is not something that's very, very easy. You look at the Chinese and you look at the Russians, that's where most of that spare capacity exists in the world right now. So when we look at the policies being implemented in the U.S. or talked about in the U.S. right now, about responding to the record margins, let's remind, this is a global problem. It's not a local problem in some place like the U.S. And the ability for the U.S. to unilaterally fix this problem is severely constrained.
So, Jeff, does it mean that actually product price will be much more elevated than crude for the next 5 years? Can it be longer? Like, what's worst case scenario?
Well, we think you're going to see some normalization in the product cracks as we go in this year, as refineries come out of turnaround and you debottleneck some of these refineries, because they can debottleneck them, put investments into the existing refinery to make it process more crude and produce more product. But it's, to give you an idea, historically, you just take a gasoline crack, it trades 20-25% of the crude price. Recently, it's been 45-50. So let's say we get a normalization down into that, 30 to 40 range. You kind of get the idea. It's not all the way back, but it's not nearly as high as what we're talking about right now. So, but I think the key point here is it gives us the revenge of the old economy. Underinvestment in refineries, underinvestment in oil production capacity, trucking problems, shipping problems. I can keep on going down the list. Copper mines. Basically, we favored short cycle iPhones over copper mines for the last decade, and this is the shortages we're ending up with.
So, Jeff, I mean, there's very tight supply, or the supply-demand dynamics are going to be very tight for 2023. What happens after that, and what happens to your forecast if we actually get a global slowdown?
Well, the global slowdown, let's say it's Fed-induced. I want to emphasize Demand destruction or demand slowdowns is not a fix to this problem. It may be a temporary solution and it may create a pullback in prices, but it's not a long-term fix. There is only one long-term fix to this problem, and that is investment, harnessing large amounts of capital into this space to debottleneck it. I don't care if it's growing supply through actual investment in production capacity or it's through productivity gains and technology. Both avenues require investment. And at this point in the game, we still don't see large-scale investment. We see outflows in commodities. The equities are trading with free cash flow yields of 25, 30%, record free cash flow yields across the entire old economy. And then you look at credit spreads, they're widening in a $120 environment. So the net of this is telling you we're still not seeing the capital flows. Now, what are the reasons for the lack of investment? Number one is a history of bad returns. Most people are pretty scarred by the experiences of the last decade, so no wonder there was no capital. Number two, the volatility is too high that scares people away. And then number three is ESG.
Yeah, right. And Jeff, I mean, I wonder whether then at this point we'll see any more capex given also the transition. But are you expecting more oil from OPEC plus once President Biden meets with the Saudis?
I mean, let's just go over, potential spare capacity, somewhere a little bit north of 2 million barrels per day between Saudi Arabia and UAE. We look at the loss in, let's say Chinese demand is down somewhere around 800,000 barrels per day. It rebounds. Seasonal uptick in demand is 3 to 4 million barrels per day. The potential right now, Russian supplies are down about 600,000 barrels per day, likely to be down 1.5 million barrels per day year in if the sanctions are imposed. So the net of that is a lot more than 2 million barrels per day of required, just call it call on OPEC or, supplies more broadly. So, and also let's remember, there's 1 million barrels per day potentially coming out of the SPR right now, and that starts to run out relatively soon. So you really ought to ask, where is this supply going to come from? And let's not forget, you have shortages in grains, shortages in gas, and then they siphon off one another. I mean, what was the immediate fix to the gasoline problem in America? Take from the corn supply, move ethanol in. Eventually, we're going to have, really serious shortages.
But it's always a timeline problem, isn't it, Jeff?
Yeah, absolutely. I just want to say, longer term, we need to get capital. And when Volcker took interest rates up, the 20% in 1979, it was off the back of 6 years of CapEx. We don't have that CapEx right now. So the terms of thinking about how long it's going to take to fix this problem. Here's another important point. Don't expect that the interest rates can come back down. You basically need to have a situation in which not only are you slowing demand growth with the higher rates, but you're then saying, hey, world, don't invest in things that are all short cycle. Going back to my iPhone versus copper mines, you end up having to move more capital into oil production, copper mines, and all of these capital heavy entities.